Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the closing action on the D Street. Well, the markets are still, low in trade. When we look at the Nifty, it's 22,562, down 233 points in trade. It's been a choppy day, but of course a narrow band of trading, and we have slipped below 22,600 right from the word go up until even now. All the sectors, barring auto and pharma, are down in the red, with sharp pain being seen across the IT stocks, with the Nifty IT index down by about almost 2.8% now. Metals down 2% as well. You have infra stocks declining 1.5%, PSU stocks 1.5% lower. Even the broader markets are nearly a percent lower, but they've recovered from the day's low at this point in time. Pharma was the lone index gainer in the morning trade, but now you have auto stocks also slowly and gradually recovering as far as the markets are concerned. If we look at the key winners on the Nifty list, well, you'll be able to spot names like M&M. That's pulled up higher. Remember, there's a brokerage houses update that has given a target of over 50% upside for M&M. Dr. Reddy's is higher in trade. Eicher, Hero from the auto space, Maruti, all of them are showing us some strength. Nestle, ITC from the FMCG pack is also pulling up, but large part of the stocks within the Nifty are still lower in trade. In the F&O space as well, when we look at today, it's Varun Beverages that's actually up and about in trade. That's almost 4.7% higher in the F&O space. Laurus Laboratories is also doing well. Then you also have names like Bata, United Spirits, CG Power and Industrials. These are some of the pockets that are actually doing pretty well in trade. Let's actually welcome our guest on board. We have Mr. G. Chokalingam joining in. From Economics, and we want to understand from him what exactly is his own study and understanding of the current market tenor and the texture. Warm welcome to you, Mr. Chokalingam, and always a pleasure to have you with us. Well, 5 consecutive months of what pain in the markets is what we are really looking at. Data points also indicate that in case we are in the last week of February, in case we end this month also on a lower note, this will be the 5th consecutive month that would spell the longest losing streak for the Nifty in the last 28 years. The last time something like this had happened, that the Nifty had fallen for 5 straight months in a row, was back in the year 1996. And before that, we had seen even in 1994, 1995, 8 months of losing streak as well. Now, what I want to understand from you is, are we in for further pain from here, or are there any signs of reversal coming into the markets right now, sir?
Yeah, good afternoon. Thank you. Uh, Definitely, little more pain is there, probably till mid-March. In worst case scenario, by end of March. I expect stability and then significant recovery from end of March or from April, and that's a new financial year. Now, the kind of fall is not surprising because the run-up also, the extent of run-up and the quality of run-up across the stocks, that also unprecedented in the history of Indian stock markets. Where we have seen a lot of bull run bubbles, but this was quite unique what we saw in the last year, because so many themes have joined, so many new age companies, so many newly listed IPOs, and so many renewable energy companies. So several themes played out simultaneously, and the valuation multiples went up to even 100, exceptional cases even to 900. So it was waiting to happen. Unfortunately, when people lose 50-60% in the bubble stock, the liquidity gets drained and it affects the quality stock also. And moreover, another interesting insight from the history is that, so whenever in the first half there was a bull run and a significant fall happens somewhere from December, January, that becomes quite intense and it continues till March, because this, I have no proof, but my understanding is that, so a lot of people, set off book losses and set off the gains made in the first half. Perhaps that strategy must be leading to, from tax angle, more selling pressure. But another interesting insight from the market is that though the fall is so intense in February, March. A lot of smart buying happens in February, March. Those who have a minimum 6 months to 1 year investment horizon, they tend to invest. They tend to do a lot of bargain buy. So that is my stand. Though the market might remain weak till mid of March or possibly till end of March, I've been writing as a research strategy to keep buying in phases till mid March or end of March. Definitely, the recovery would come. I would give 4 or 5 reasons for that. One, Mr. Trump has been giving a lot of threat on the trade war, and some of the countries, including India, they already started taking action. We already reduced the duty on a couple of products from the US,
Hmm.
and also we have increased the import of oil by about $10 billion in January. And so not only that, India is not a major threat to American economy because our trade surplus with America is not comparable to over $360 billion surplus China creates from US. So third, the GDP growth is expected to improve in the second half. A couple of days back, RBI also mentioned that H2 GDP growth would be better. ICRA also has given better GDP growth outlook as compared to Q2. And fourth, as of today, we have lost almost 85 lakh crore rupees, 85 trillion rupees from the peak of overall market cap in September. That was around 484 lakh crore. In the process, a lot of stocks, as I mentioned earlier, have become extremely attractive. Ups and downs are common. This kind of fall in terms of percentage, it happened many times in the Indian history, particularly for small and mid cap. Same Indian history also proves the point that they never fail to bounce back the quality of stock. If you have not made a blunder in selecting the stock, you don't have to worry. If you have taken investments in a quality stock, many of them would recover. That has been the history. So also finally, the Korean agency has given a normal monsoon forecast. That is also positive. And today, despite such a meltdown, the retail investors are continuously pouring into the market. Even last week, 6 lakh investors have registered for the first time on the capital markets. So I remain extremely optimistic, especially from April first week. But yes, there will be a little more pain. We have to face it for another 2 to 6 weeks.
Okay, 2 to 6 weeks of more pain, but things could be going well. So one should definitely keep on investing at this point in time. Let's try and figure out any pockets that we can identify where, Mr. Chokalingam, you can give us some ideas where investors can actually put in if they're sitting on cash and they want to deploy. Let's discuss a few pockets. Pharma space particularly first, and the IT space as well. Two from the defensive pack is what I wanted to discuss. How are you looking at both of these? Today pharma is up slightly higher, but IT is in deep pain. Both are export oriented sectors. Like you did talk about Donald Trump and the impact that we are seeing from policy changes there. These are the two vulnerable sectors that we feel because they are the ones which have maximum exposure to US as a business. Your suggestion of how should one approach IT and pharma, and is there a different approach to both right now?
Yes. In pharma, one should focus on the companies which primarily cater to domestic markets. That should be the strategy because we are not sure ultimately what is going to turn out in terms of final ruling from the US government on export of pharmaceutical product from India to US. Still, there is uncertainty, and our dependence on US is very heavy. There can be a lot more stringent measures from US FDA also. It is not only that the tariff has to go up to control the supply from India. More stringent measures can be taken by US FDA also to control the export of pharmaceutical products from India to US. So I'm not forecasting that, but one has to wait. So the safest strategy would be to focus on domestic pharma. As we discussed already, we have a coverage on FDC Limited, and we like it a lot, though it has fallen. Now it has become extremely attractive. The domestic business is valued at around 2.8 times, 2.5 times, and most successful domestic formulation companies are trading at 3 to even 6 times enterprise value to annual sales in this market. As far as IT is concerned, there, we don't have a tariff fear because, the companies which are based in US, they pay GST, they pay income tax, and those rates are comparable to import of IT services from US into India. Of course, we don't have any significant presence of US IT services in India, but at least for Mr. Trump, there is no worry that we are exploiting in terms of tariff differential as far as IT sector is concerned. But still, we do not know whether there will be any qualitative control on export of IT services. So therefore, I would be less aggressive on IT space, and I would completely wait for the companies which are exporting to America in a big way in pharmaceutical sector. So my focus, I have been telling our clients, research clients, that focus on domestic business, domestic market, and domestic investors, particularly the retail investors who would largely focus on small and mid cap. So I have been suggesting small and mid cap quality stocks, which depend on domestic demand and which are liked by domestic investors. That is my thing.
Okay, got that. Let's also discuss one more pocket, and that's the auto space. Again, there is some linkage with US here, of because of Trump tariff talk, and also because of Tesla entering, BYD entering. This space has been pretty, jittery with these newer competitions also coming in. Already the space was in a flux this entire previous year because of semiconductor related issues, muted demand kind of issues as well. At this point in time, sir, how are you looking at the auto space after the recent correction that has happened on most of the companies, like say M&M for that instance, Tata Motors for that instance, and many others such? What is the exact strategy that you are advising to investors?
In our research recommendation, we are avoiding large auto players as well. A couple of days back, we saw in the media that there was a SIAM meeting and a lot of discussion about growth potential for automobiles in FY26. And it is mentioned that in FY26, the volume growth can be 1 to 4%. But however, top automobile players were quoted saying that their individual volume growth could be even 1 to 2%. So the point is that without Mr. Trump coming into picture, our automobile sector is already into some difficulty. The volume growth is under tremendous pressure. And not only that, the SUVs were helping whole sector. Till recently, the SUV sales were 30 to even 40, 50% on year basis. That has come down to now just 8%. So in my research, I've been avoiding auto sector also.
Okay, fair point. Avoiding the sector at this point in time. We'll also understand a little bit on the mid and the small caps spaces also, sir. These spaces are again turning out to be pretty vulnerable in the kind of sell-off that we are seeing right now. Is it still time to stay very, very cautious on the mid and small caps? Those having huge exposure to this space, what should they do? Should they cut down? Should they, probably just wait it out? What exactly would you advise?
Yeah, very interesting question. If you allow me, I will take a 2 3 minutes extra
Absolutely.
time. See, there is a dichotomy within the small and mid cap stock. Now, if you look at BSE small cap and BSE mid cap PE, somewhere around 32 for mid cap, around 28 for small cap. The universe of small and mid cap is so huge. The index P's are still elevated. That throws insight on the dichotomy within the small and mid cap. What I mean is that, in fact, on your channel, I have cautioned many times that there are two set of stocks within the SMC, small and mid cap segment. One set of stocks having abnormal P multiples, valuation multiples, and that was not justified in terms of their profit growth on year basis. So I was cautioning on many newly listed companies, new age companies, renewable companies, thematic companies. They were trading at 50p, 80p, 100p, but the profit growth was not even half of that year profit growth. So that is the main reason for the entire small and mid cap to lose about 50 lakh crore of market cap from September 2004. If you look at the BSE small cap and mid cap indices combined market cap, it is down nearly 50 lakh crore in the last 6 months. So one should be very cautious even now on that particular space. Having burned the finger, you be cautious on small and mid cap stocks where If P is still 40 and the profit is not even growing at about 20%, avoid them. Wait for another 1.5 months. Then the second segment, which is a slightly smaller segment, is that even in September month, if there were many stocks, the profit was growing at 20%, but the P ratio was 70, and well-tested management, good balance sheet. But a lot of youngsters, they just started chasing the momentum, not the value. Not even I would call pure value, even the growth stock, but which were not in the limelight, which were not having any attractive theme. So they were ignored. And unfortunately, even those stocks have corrected 10-20% in the meltdown, because in other space, the meltdown has been even 50-60%. So the quality stocks also have become victim of selling pressure. So I would say that focus on small and mid cap stocks, whose P ratio you compare with the profit growth. If P ratio say 20 and profit is growing at even 15%, 20%, and also the balance sheet is good, management is good, and there is not much leveraging, there is no working capital crisis, I firmly believe that this is the time to accumulate such stocks. Let me tell you,
Okay.
I have seen meltdown in 2007-8. I have
Yeah.
seen meltdown in 93, meltdown in 2016, COVID, 18-19 also in the small and mid cap. But Indian market is a beautiful market. uh, Invariably the quality stocks have recovered, and they have given significant wealth creating opportunity. So focus on that segment instead of the momentum driven, purely momentum driven without justification on the basis of proportionate growth in the profit. That is a sector, be cautious.
Okay, great. I hope this has really given a lot of clarity all our viewers who are looking for how to look at the current setup of the markets, the various segments there, where to be cautious on when, where to really look for opportunities. Mr. Choklingam, we are also at the end of the earnings as well. I wanted to get a sense of your own assessment of how did you find the Q3 earnings play out? Any key sectors that stood out for you in terms of performance? Where were you disappointed the most? Where do you actually see continued disappointment even into the next quarter as well? So that will also give a sense to all the positional investors or the near term, medium term investors as well, as to how to look at things where probably the signs of reversal or green shoots have started to emerge, whereas where there could be some more time to take.
Yeah. Unfortunately, the slowdown in GDP growth in the first half is having impact on the corporate earnings now. And also, traditional economists would not accept, and not many discuss about this. I have seen in the last 33 years, whenever such a meltdown happened in the overall market cap, now today, as I mentioned, 85 lakh crore of equity wealth is wiped out. Definitely, in certain sectors, it will have a negative impact. Sectors like real estate, automobiles, and lumpy consumer durables. So slowdown in growth, and the wipeout of over 85 lakh crore, because which is equivalent to 26-27% of India's nominal GDP. So you can't write off the adverse impact of this meltdown in the market. So what I'm trying to say is that in Q4 also we'll have a little pain on earnings, and particularly the large cap sector. Now, if you look at, say, Nifty 50 stocks and you segment them in terms of sectors, it's very difficult to see more than 2-3 sectors which give you confidence on double-digit earning growth. Cement has a problem, automobile has a problem, pharma now because of Trump, and then you IT services. If you look at in dollar terms, the poor single-digit growth. So, one or two, three sectors only have some promising, like banking still growing, businesses growing in double digit. So, however, one need not worry. Still, I am saying that market would recover from April. As all of us know, the market always discount the future. But Q1 or Q2 onwards, you would definitely see the improvement. And the reason for being more tilt towards small and mid cap is that, as I mentioned, two-thirds of the large cap sectors, the large cap stocks, if you segment them, they have a problem of not able to get a double-digit growth. But you have 4,000 stocks in small and mid cap. One can easily identify 50 to 100 stocks which still would grow the profit in double digit without any uncertainty. So that is where I believe the first recovery would come as and when the market bottom out. For one more reason, Today, the retail investors, as I mentioned, even now 6 to 8 lakh investors are coming every week, and their equity ownership is now close to 10%. And then you have domestic mutual fund 17. So combined together 27%, vis-a-vis 17% equity ownership by FII. I think the structural change is also in favor of, the once again the revival of small and mid cap. The retail investors and mutual funds would definitely go after quality stocks which are beaten down, and therefore instead of focusing on the large cap stocks largely, I would give large focus on small and mid cap stocks which are beaten down, which have a good management, good balance sheet, comfortable valuation zone. That is the area one has to focus for next 1 or 2 months.
Okay. Would it be fair to ask you, sir, any key names that you may have identified, advised your clients, or otherwise for our viewers as well, in the recent dip that has come in, and from which are the pockets and the stocks that you believe now are looking attractive and hold a lot of value at this point in time, sir?
Yeah, I have picked up 5 stocks.
Okay. Okay.
Carefully picked up the stock where I have not invested for compliance reason. I have extraordinary faith in these stocks. One is GE Shipping, leader in shipping. The free cash is 33% of the market cap. It's a phenomenal dividend they pay. They are extraordinary quality management. They are very smart in selling the ships also and making money. And a couple of weeks back, they delivered one more ship. So Q4 results also would be very good. And the P ratio is 6. So this is stock I like, we have recommended. And then PNB Housing trading at just 1.3 times or 1.4 times price to adjusted book value. It has got exposure to own public deposits, which is about 40% of the total finance the company has for deployment. So today we know the banking lending to NBFC has slowed down enormously. So here you have a housing company, housing finance company with phenomenal quality, PNB Housing. Third, CDSL, it has fallen almost to 40%. I'm a bit surprised. Yes, it used to trade at 60 PE, now it's around 40 PE. I think this is a phenomenal medium to long term stock. You have duopoly market for depository participants, CDSL, NSDL, and CDSL is the leader. As I mentioned, if you have a 3 to 5 year, 10 year, or 20 year view, the stock market, the breadth, depth is going to increase continuously and consistently. So here you have a player, CDSL, which is a growth stock, which will benefit out of that, the perennially growth story in the Indian capital markets. And then, as usual, Bank of Maharashtra, extraordinarily quality mid-sized bank. Net NPA is 0.2. There are only 1 or 2 banks have that kind of quality of assets. And just quarterly profit itself is a multiple of outstanding NPA. I would, as an analyst, I would give suggestion that the management should, in one go, write off entire net outstanding and declare zero NPA. That will be unique in the history of Indian banks. And also the stock has corrected and trades at around 1.4 times, the book value, price to book value. And being positioned in Maharashtra, which is the most developed states, I am extremely bullish on this. And then finally, Indigo Aviation. I picked up one large cap also. The oil price is now down 18% from the 52-week high. In fact, on Friday night, US officials made a slogan, map and go after oil and gas deposits. So very interesting development last weekend. They want to increase the oil and gas production within US and reduce the import dependence. Second development, all we know that there has been a lot of talk between US and Russia to resolve Ukraine war. The day any formal announcement comes on the discontinuation of the war, oil can fall 5 to 10%. And with higher oil output from US, I am pretty confident that oil price will crash at least another 10, 15, 20%. And in the last 20 years, 3, 4 times, oil price crash helped Indian economy, Indian markets to recover in a very big way because we import 143, 145 billion worth of oil. So even 20% crash in the oil price would give enormous relief on forex reserves and therefore reduce enormously the pressure on the rupee exchange rate. So, and in such a scenario, India would be a major beneficiary because they spend a lot of money on fuel. So these are the 5 stocks we have recommended officially, and we do not hold any of them directly or indirectly through any friends, relatives, or proxies.
Okay, so there are 5 stocks that Mr. Choklingam has highlighted in this falling market in case you are looking to take the benefit and invest for the long term, looking to add quality stocks to your portfolio, which over a long time can actually give you healthy returns as well. These are companies that Mr. Choklingam has studied deeply, their business models, their performances on the earnings level, as well as the way the potential has been as far as the stock prices are also concerned, the way their industry is growing and shaping up as well. I hope all of you take down these names, and we will also chunk this portion out for you to see on our YouTube as well as on our various social media platforms to really look at these top 5 stocks that Mr. Choklingam has shortlisted for all of you viewers in this falling market. If the question is coming, where exactly should you put your fresh money, then these are some of the stocks that you could definitely look at. Also, do speak to your own financial expert before investing in them. All right, lastly, Mr. Choklingam, if I have to ask you, of course, you did say 4 to 6 weeks or more pain. But once the reversal starts, what should be investor strategy is what I want to know. That everybody is preparing for this last phase of a pain to go away. What is the strategy that one should adopt when things start to look up?
Unfortunate truth is that, particularly in small and mid cap, when reversal starts, 90% of the investors lose opportunity in 90% of the stocks because reversal also sudden and sweep. So let me tell you, the fact which is not highlighted, properly, adequately, in the last 10 years, there has been a tremendous structural change. The technology has penetrated. So the dissemination of information is instantaneous, and the execution of the trades also happens instantaneously. So the moment the people get confidence, everybody is going to react on same second to chase the stocks. So you will not get most quality stocks very cheap. So that is why you have to change the strategy. You don't try to do a buying at the bottom and selling at the peak is not possible at all because of this structural change. So one has to spread it till the date you think it is going to bottom out. And so therefore, your strategy should be starting from today till whenever you think it is going to bottom out, you have to do it in phases. Otherwise, it is not at all possible to wait for the best opportunity to buy. The market will not give you a chance in 8 out of or 9 out of 10 stocks. So even now choose the domestic businesses, and B, see that the durable business gives you a lot of confidence. And third, the valuation comfort. As I mentioned, always never miss the link between the P ratio and the annual profit growth. See that year-on-year profit growth is at least half of the P ratio, and see that the debt is very low relatively, and see that working capital crisis is not there. There are some companies, the receivable and the inventory itself is more than the annual sales. Of course, one can exclude sugar, seasonal businesses, but other businesses where you have this kind of problem, there are companies have receivable under non-current account, so which is very unusual. You have to write off for more than 1 year if you are not able to get it from vendor. So these are the parameters you look at. Be ready with your ideas. I may be wrong, but this is my conviction that it is amazing time to accumulate till March 31st in phases.
Fair point. Well, thank you so much, Mr. Shoklingam. Always appreciate you having with us on Business Today to guide us through the wealth of experience that you have in various cycles of the markets, and that clearly gives a lot of clarity to all our viewers also to think clearly and without panicking and worrying, continue to focus on their long-term growth story and wealth creation goals as well. Thank you so much. Appreciate your time yet again. Markets shut shop now, 247 points lower, 22,548 on the Nifty. You have the Nifty Bank down by 0.6%, slightly better off than the Nifty in terms of percentage fall. Sectors, barring auto, pharma and FMCG also pulled up in the last few minutes of trade. So you have the defensive space definitely pulling up, FMCG, pharma, and autos also recovering a bit, but IT was a clear pain point. And most of the experts who have come in today, at least on our channel today, right from Vineet Bulinchkar to Vaishali Parikh to Kush Kotasara, Nilesh Shah as well as Nilesh Jain and also Mr. Chokalingam. Everybody has sensed some caution on the IT space, so keep that on your mind too. Apart from that, the broader markets definitely recovered from the day's low, but still ended in the red. About 1% for the mid caps, over 1% for the small caps. Oil and gas, infra, consumer durables, banks, financials, all of them also short pretty much lower in trade by over 0.6, 0.7% as well. Realty also down by 0.8% too. In terms of the key stocks then, the biggest laggards for the Nifty came in by way of stocks from the IT pack. Reliance Industries, of course, over 1% lower within the heavyweight banks. ICICI Banks, Bajaj Finserv as those that decline. Shriram Finance as well. You also had IndusInd Bank also declining in trade. Then IT stocks like Wipro, HCL Tech, Tata Consultancy Services. Then you had Infosys. All of these stocks declining by 3.5 to 3% odd. So these were the top drags on the Nifty. Of course, winners were far and few between. Among the broader markets, when we look at the kind of moves that we saw, you had on the winning side Imami Realty, Orchid Pharma, Swan Defense, GlaxoSmith, Klein Pharma, GSK Pharma, that was up 5%, Eveready Industries, Vesuvius India, Data Patterns pulled up by over a 5% as well. Happiest Mind Technologies from the IT space bucking the trend in an overall weakness that was persisting in the IT pack. You also had names like India Hume Pipes, Apollo Pipes also pulling up towards the end of the session. Some of the paper related stocks including Srirama, Newsprint and many others such that also pulled up in trade. On the lower end, we did have names like Sangvi Movers, Inox Wind Energy, Jyoti CNC Automation, Thangamile Jewelry, NTPC Green Energy, Automotive Stampings of India, Gokaldas Exports, all of them declined in trade. Of course, some of those export oriented sectors with those Trump tariffs coming by way also getting impacted in trade. With that, we wrap up the trading session. Another week that started on a weak note. This is the F&O expiry week. We've ended the last week of February. Remember, in case the markets end this month also on a negative note, that would break a 20-year-old record-breaking streak for the Nifty as well. 5 months of consecutive losses not seen from the time of 1996. That would happen, and this is because all the pain points are coming together. Let's actually get you all the post-market coverage as well by way of how to understand the current business and economic environment as well. So stay tuned with us, a lot more coming up, and market coverage will begin again tomorrow morning. See you soon.
First of all, it is a very good feeling to come to, always a good feeling to come to Kashi, but particularly during the Kashi Tamil Sangama. I had come last year also, and this time I brought with me 45 diplomats, mostly ambassadors.